Okay, welcome everyone. So thanks very much for joining. You'd have all seen our adverts or invitations on combination LinkedIn and email. So hopefully you find today's session interesting. This is all about essentially making more money from your business, making it work more for you. So this kind of the theme we've got today is I'm a CFO for small businesses, so I'm going to be talking about how to kind of get your business functioning more efficiently, so it's actually making more money. And then Karl is an accountant, and he's going to talk what you then need to do to take as much money out of the business as tax efficiently as possible. So I'm going to talk about the making money aspect part. Karl's going to talk about the extracting money part in the most tax efficient way possible. So the agenda for today. So we'll start with a bit of context: why most businesses fail, how to get back control of your time and money from your business, the main drivers that drive revenue, profit, and cash flow. So this is essentially the process that I implement with my clients. And then Karl will talk about the 5 common mistakes that business owners tend to make with their finances when it comes to taking money out. The difference between profit and cash. Very regularly, I'll get queries from my clients saying something along the lines of, we made 100K on the profit and loss last year, but we've got 10 grand in the bank account. So what's going on? And that's because profit and cash are 2 different things. So Karl's going to explain the difference there. Bit of housekeeping. So we'll be here about 35 to 45 minutes. About 30 of that, Karl and I will be talking, and then we'll have some Q&A afterwards. So any questions you've got along the way, we've got a nice small group here. So anyone who wants to speak or ask a question, just unmute yourself and feel free to jump in. And any questions you've got, put in the chat, and one of us will be monitoring that as well. So introduction to me. So my name is Tom Griffiths. I've been in finance for about 10 years. I worked in investment banking in the city for the first 7 or 8 of that. And then about 3 years ago, I left at the end of COVID, wanted to start my own business and kind of do something a bit more entrepreneurial, and essentially worked out that a lot of business owners they struggle with their finances. They don't have clarity on where they're at with their numbers. They don't know how to use that information to work out what's working and not working in their business. And then they don't know how to work out what to do next so that they can keep the business healthy and improve their profit and cash flow. So I use my financial background to help small businesses with exactly that. And my mission is to help as many as I can to have a growing, healthy, successful business, however they define success. So that's me. I'll let Karl introduce himself.
Thanks, Tom. So that's me, Karl Roberts. I own an accountancy practice called GMR Accountants. I'm a part owner, so I have a business partner. I bought into the business 2012. Up until that point, I was your typical accountant, preparing accounts, tax returns, doing all that lovely stuff. And it's only when I started creating relationships with my own clients that I realized that accounting, or what I could provide, I should say, to my clients could be so much more. So I kind of turned my business to more of an educational model, actually helping people understand their numbers. So that my aim is to help business owners gain a better understanding of their numbers so that you can gain control over their finances, which results in a more profitable business, which enables them to reach their personal goals.
Excellent. All right, thanks, Karl. So I'm going to give a bit of context about kind of why we're here, why Karl and I both do what we do. So most businesses fail, and here's some stats behind that. So these are US stats, but exactly the same stats apply in the UK and Europe. So 20% fail within their first year, 35% in the second year, 50% by the 5th, and the stat for 10 years is actually 90%. So think about that. All of those business owners who start their business because they want freedom, ultimately, time freedom or financial freedom or whatever that looks like for them, 50% have gone in 5 years and 90% within 10 years. So what does that say about all of those, the business owners who put so much in and end up having to close the doors? And so what's the reason that they fail? And what it comes down to is something very simple. They lack cash or money. Okay, so no business owner is going to close down a business that is generating enough cash. If a business is generating enough cash, that cash can be used to solve any problem in a business. Okay. Now, where do we get cash from? So three places for any business in the world. Doesn't matter whether you're Uber or Amazon or a dental practice on a high street. So three places. One, the business can borrow money. Two, the owner can put money in. Or three, we can get money from the business as it's generating cash. Okay, so which one of these is the best source? Karl, I'll let you go.
Sorry, Tom. I was too busy engrossed in the slide there. Definitely business.
I wasn't gonna pick on anyone, but I thought, yeah, I'll pick on Karl.
Definitely profits from the business is the best way to generate cash.
Exactly. Profits from the business is the best place to get cash. There's a limit to how much any owner can put into any business, and debt is only good if it's being used to produce or invest in something that's going to have a positive return. So clearly, what every business owner needs to do is work out how to get their business to produce enough cash flow and profits so that they can solve the problems that they face within their business, so that they can avoid the failure rate, and then more importantly, so that they can achieve whatever version of freedom they are trying to achieve or they started their business for in the first place. So what we need to do is we need to turn our business into what I call a money-making machine. Okay, so the way I like to think of this, the analogy I like to provide is the washing machine example. Now, Karl likes this. So what do we mean by money-making machine? So let's think of a washing machine. The purpose of a washing machine is to wash clothes. If the washing machine fails to do what it's supposed to do, which is wash clothes, then there is a reason that it's failing to do that, and we need to fix it. Okay, so we need to work out why, and then we need to fix it. And it's exactly the same thing with the business. So if we think of our business as a machine, we need to work. If our machine isn't doing what we need it to do, which is produce cash flow and profits, the same for any business, then we need to work out why it's not doing that, or why it's not producing cash flow and profits to such a level that are going to enable us to achieve our personal and professional goals from the business. Okay. As I mentioned before, cash solves any problem in a business. So we can use that excess cash that the business is producing to then solve any problem in the business. So if we want to work 1 day a week, for example, then we can use the excess cash in the business to hire a management team. Or if the business is exposed to one particular client, then we can use the excess cash in the business to invest in marketing so that we can get more clients and diversify our risk. Okay. So every business is made up of exactly the same parts, just like a washing machine. Okay, what we need to do is get familiar with what those parts are, and then get familiar with how to work out which are the parts that are causing our machine to not function in the way that we want them to do. Okay. So if your business isn't producing as much cash as it should or as it needs to, then the worst case scenario is you go out of business, and you're one of those 50% that go out of business within 5 years. Okay. And if you're not quite there, but you're nearly there, then the business will just continue to struggle. And what happens when the business is struggling, which is the case for the vast majority of businesses or business owners, is the business owner just ends up spinning all the plates, keeping busy, because they don't really know which part of their machine, part of their business is not really functioning properly. So they don't know how to address it because they're not focusing on the right area. So they just spin all the plates, keep busy, get stressed, work all the hours under the sun, and nothing changes. Okay. Most business owners are worried about their business closing or failing for a few reasons. Firstly, is because they're fully dependent on it. They need it to work provide for their family. And number two is that they can't go back to a job. They've had a taste of the relative freedom you get when you start a business, and they just don't want to go back to the corporate grind. So if we know all that to be true, then how do we well, in fact, first let's differentiate between a machine and a job. Okay, so most business owners have got a stressful, low-paying job, and most business owners don't realize this until a long time after they've started the business, often years. And by that point, they're, like I said, working all the hours under the sun, trying to spin all the plates in their business, and just keeping busy. And most business owners obviously start their business because they want the opposite of a job, freedom. Okay, but in doing so, they lose the very thing that they started the business for in the first place. Okay, so they lose that control. So most business owners, they will start their business because they're experts at a craft. So a builder is an expert at building, and so they start a construction business. A dentist starts a dental practice, marketer starts a marketing agency, so on and so on. But what happens when when a business owner starts a business that they're an expert in that craft in is that they inadvertently become a business owner. And when you're a business owner, you have to understand how to produce profits and cash flow, how to manage your finances, how to stay on top of your finances, how to understand where you're at, and then how to use that information to work out what to do next. If you don't do that, then the business is going to struggle at some point in time. Okay. And what usually happens though is that the business owner just continues to do what they know how to do, which is their craft. Okay. So they're an expert at building, so they think that by focusing their attention on building, that the problem will go away. But it doesn't go away because they're not focusing on the actual numbers and what's driving the business. And they rely on their skills, like I said. And then the other parts of the business struggles. Okay, struggle. And then the business itself struggles. And then their craft struggles. And then they realize that they're in a stressful, low-paying job. So the solution here is to turn the business into what I call a machine. So using the analogy that I've been through, is here. So we need to turn the job or the stressful job into a money-making machine. So if we can do that, we can do three things as a business owner. We can firstly take the money out for personal use. We can go on holiday. We can pay for our kids' education, whatever it is. We can use the money to grow the business, or we can use it to increase the value. So like I said before, that cash that we're generating in the business, we can use to solve all the problems that we face in the business. Sorry, it's someone joining. So let's go through the exact process that I go through with my clients to make that happen. So we need to break down the business into the 16 parts. So these are the same 16 parts, whether you're, again, Uber, Amazon, Google, a one-person dental practice on a high street, exactly the same. And just like a washing machine, we need to work out which part is working or not working as it should, and then focus on the part that needs. So each one of these parts drives the number that is most important at the end of the day, which is cash. Okay. So I'm going to go through each one of these very quickly and explain how they all link together. So we start with leads at the top of the funnel, if you like. So if we don't have any leads coming through the door, then naturally we have no opportunity to turn any clients into sales. So number of leads, this is the number of clients that have been made aware of what you're doing and have put their hand up as interested in what you're doing. Conversion rate, this is number 2. So this is the percentage of those leads that become paying clients. And we have retention rate, so the number of those clients that you've converted that stick around with you. Number 4, which is number of times each client purchases within a year. And obviously the goal of each one of these stats so far is to increase it as much as possible. Then we have average transaction value. Again, goal is to increase this by as much as possible. So that's revenue. And then we move on to profit. So the first driver of profit is obviously the revenue. And then we take off the direct costs that we have incurred to deliver that sale, which is cost of goods sold, cost of sales. We measure that as a percentage of revenue because it's much easier to see the trends that are happening when we do that. Then we take off the marketing expenses. And again, we measure that as a percentage of revenue so that we can see any trends. And then we take off payroll expenses and overheads, being things like rent, insurance, office supplies, that sort of thing. And then any other bits and pieces that contribute to the profit number, but are not a core part of the business's operation. So for example, interest income, that sort of thing. And then we end up with profit. So in the example I gave earlier, if the business is left with 100K in profit at the end of the year, that's what they're going to see at this point in time. But then before we get from profit to the amount of cash available for the business owner to actually take out of the business, we have the cash flow drivers. So we have days sales outstanding. So this is the number of days it takes to get paid. So let's say we end the year at 100K in profit, but 50K of that is actually a bill that hasn't been paid by a client. Then our cash is going to be 50K lower than that 100K. Okay. We have days inventory outstanding. So this is only applicable if you're selling inventory. But this is essentially the number of days it takes you to sell your inventory. So the longer you hold on to your stock, or the longer it takes you to sell everything, the longer this number is going to be, and the longer your cash is going to be tied up in this. Okay, then we have the sale or purchase of assets. So in that same example that I've just been through, from that 50K that we're left with, let's say you need to buy a new van for 20K. So now we're left with 30K now. Okay, so now that 100K profit that we started with is now down at 20K. Okay, and then we have the days payable outstanding. Let's say this is essentially how long it takes us to pay our suppliers. So we want to keep this number as high as possible without upsetting anyone. Okay. Then we have using or paying down debt. So we should be careful with debt. Debt can be good, but it can also be dangerous. So we want to make sure that we're using debt to invest in assets or things that are going to have a positive return on investment. Okay, so again, let's use that example that I went through earlier. We're left with was it 30K, Karl? We're left with 30K. Let's say we're left with 30K.
20, I think it was.
20. We're left with 20K, and then we need to pay down 15K of debt. Well, that's a cash flow that's going to come out of the business. Okay, so now we've got 5K left. Okay, so now we've almost run out of cash. And then the final driver of cash flow for the business is how much the owner takes out or puts in. So we want you as the owner to take as much cash out as possible from the business. But obviously, when you're taking cash out, you're starving the business of cash. So we need to make sure that we're taking cash out when the business can afford for you to take cash out. Okay. So as you can see, all 16 parts of that I've just been through drive the following part. So if you start with 0 at the beginning, the number of leads, it's kind of 0 all the way through. And each one of the 16 parts has a significant impact on the business. So if we can focus our attention on improving just one of these parts every month, then that is going to have a significant impact on cash flow and profits at the end of the year. And so essentially what the process is you get clear on what these 16 parts are for your business every month, and you focus your attention for the next 30 days on the driver that's going to improve revenue, cash flow, and profits by the most amount every month. And I'm not saying you're going to magically fix it from one month to the next, but by focusing your attention as the business owner on the number one driver that's going to have the biggest impact on cash flow and profits, and you repeat that process and you successfully focus your attention on those things and don't get distracted by all the other things that we get distracted from, then it's going to work. Okay. So the process that I take my clients through using those 16 drivers is as follows. So yeah, refresh on kind of what we've been through so far. The point of the business is to make money. And we then use that money to reinvest into the business and help us achieve our own version of freedom, whether that's financial freedom, time freedom, whatever it is. In order to do that, we need to have a process and a system in the business that helps us and facilitates us in doing that. Otherwise, we're just driving blind every month and we have no idea what's going on. And this is the area of my area of expertise that I focus on. Okay, so I focus on implementing this exact process and help my clients turn their businesses into money-making machines. Okay. And this is the process that I go through. So firstly, we set targets. So let's say you've got a 3-year target of working 3 days a week or selling the business. It doesn't really matter what the goal is, but the point is we set a target so that we've got something to work towards. We then break that target down into what we need to hit this year to get us on track to achieving that 3-year target. And the reason I say it doesn't matter what the goal is because the way that we're going to achieve it is the same, and that is by producing enough cash or getting the business to produce enough cash so that we can allocate that cash and increase cash flow and profits in the business, so that we can hit that target. So to do that with our target in mind, we look at what's happened every month. So we analyze where the business is currently at. So this is a review of the numbers, all the financials that most business owners don't like looking at. We need to look at them. We need to understand what's going on. Okay. Using that information, we then look forward. So where does it look like we're going to end the year? So we create a forecast. Now, forecasts are often a finger in the air, but we create an accurate picture, the most accurate picture we can of the next few months in terms of cash flow to make sure the business is going to run out of cash. And then we work out where it looks like we're going to end the year in terms of revenue, profits, and cash flow. Okay. And based on that, we're going to be able to mark whether it looks like we're on track or off track for each of our 16 drivers. Okay, so we're going to literally have red, amber, green against each of those 16 drivers by comparing the forecasts to our target that we set here. Okay, so red, amber, green across the whole business. So there's 16 boxes, and they're going to be either red, amber, or green. And then based on our red, amber, green, we're going to work out which one of those drivers we need to focus on for the next 30 days. So essentially, we're going to focus on the most red drivers. The most red drivers are the ones that we're least likely to hit in terms of our targets. So if the business is in trouble, then we need to focus on the things that are going to have the biggest impact on getting the business out of trouble and getting us on track to hitting our targets. Even if the business is on track, which are the metrics that are going to move the dial the most in terms of achieving or beating our targets. Okay, so we'll create three or so objectives for the business owner to focus on for the next 30 days. And then it's about creating clear next steps so that the business owner knows exactly what to do. So very clear, what are you going to do for the next 30 days to get you on track to achieving that goal? And like I said, we're not going to magically fix the business in 30 days if there's something bad going on, but we're going to take the right steps so that the dial is moving in the right direction. And we repeat that process every single month. And by repeating that process every month, the business owner is going to have clarity. They're going to know what they need to focus on, and they're going to be focused with their attention and moving things in the right direction. Okay, so that's it in terms of the business side of things. I've been talking a lot, so I'm going to have a break. I'm going to let Karl take over. Over to you, Karl.
Brilliant. Tom, I actually forgot that I was co-host at some point because I love that. That resonates so much with what you've just gone through there, because I've worked with lots of clients, hundreds, maybe even thousands of clients for the last 20 odd years. And the problems that you laid out, just describe so many of them. And then the fact that when you've just simplified everything with those 16 levers that any and every business can apply to their business, I just think it's brilliant. And then to round it up with the plan, there's so many similarities there with how we work with our clients. They're trying to pull them out of the business and look at it from a different angle. I think you've just done a brilliant job there. Right, so hopefully I can follow on from that, Tom, and let's talk about the 5 common mistakes that I see that business owners that I work with make on a regular basis. You can tick me on to the next one, Tom.
Yeah, sorry, I'm the one controlling
Ready?
the slides, so just give me
Yeah,
a
yeah, you're gonna have to press the button for me, mate. And everyone's probably looking at this thinking, oh, geez, he's going to talk about bookkeeping. I am going to talk about bookkeeping because it is the foundation. All that lovely stuff that Tom's just talked about, all these levers that you can pull, those 16 drivers, they're levers that you can pull. But if you can't see them, how do you know which one to pull? And that's all driven by the bookkeeping. That's basically the entering financial data, entering your bank account information, your sales invoices. It's getting that into one place so that you can see how your business is performing. Now, most business owners view bookkeeping as just something you've got to do for the accountant and for the VAT man. It's a chore, it's a hassle, and I'm not going to argue with that. I'm not a fan of bookkeeping myself, but it has to be done. It really does have to be done. And there are ways that you can automate bookkeeping. You can use software that links to, so I'm going to say we use Xero exclusively. There are other softwares out there. I can't comment on them, but we use Xero, and we try and use other bits of software that will plug in and automate as much of that financial data entry as possible. And the other thing to say is it doesn't have to be you, the business owner, doing this. In fact, it's probably one of the very first tasks that you will give up as a new owner. You know, you want to find yourself a good bookkeeper who enjoys this stuff. I've got people that work for me that love bookkeeping. You want to find people like that really enjoy it, and then basically they're putting the finished product in front of you. They're showing you the profitability. They're showing you where the money is. They're showing you those 16 levers that Tom's just discussed. So now you can stand back and see what your business looks like from a numbers point of view. So bookkeeping, whilst it's not the most exciting thing, it's absolutely crucial so you can see your business and actually make some financial decisions. On to the next one, please, Tom. Okay, all right, this is a big one. Big one and a common one, mixing business and personal expenses. Now, I deal predominantly with limited companies. I'm not sure if the guests here are limited companies or sole traders, but this mainly accounts for limited companies because your limited company is separate to you. Whilst you may own it and whilst you may be in charge of running it, it is a separate legal entity to you. But what I find a lot of business owners doing is treating their business like a cash machine. You know, I've got somebody in my mind right now who believes that they kind of withdraw about £30,000 a year in terms of dividends. There's £2,500 every month that gets transferred from the business to their bank account, and they believe that's their dividends. However, when we tot everything up at the end of the year, their dividends are much higher because there's so much personal expenditure going through the limited company accounts that are not classified as a limited company expense. Things like meals out with a family, Amazon. Just because you can pay for business stuff on Amazon doesn't mean that every single expense going through Amazon is going to be a business expense. So personal stuff should sit in your personal account, the business stuff in the business account. Things like cars trip people up. You know, the business has to own the car for it to pay for all its expenses. And often it's not tax efficient for a business to own the car. So if you're putting yours and your wife's car payment through the company and your children's car payments through the company, that will be shown as a personal expense. And all this needs to be needs to be covered by way of dividends or a loan or something. And it just creates a mess. And you can't actually see how your business is performing. Let's say if you're the business owner doing the bookkeeping and you're putting all these personal expenses through and you're looking at it and you're going, I've got low profit this year. I'm not going to pay a lot of tax. And then the nasty accountant comes along and says, well, actually, that's personal, that's personal, that's personal. Soon that low profit builds up because you've moved all those personal expenses over to what's called a director's loan account. Won't get too much into that today. But ultimately, the profit becomes a lot higher, and therefore there's a much higher tax bill. And it might not be that the cash is there available to pay it as well. So be very careful with the personal, with mixing things. I like to kind of set a standard amount that you would withdraw. So for this client, 2,500 wasn't enough. So maybe that should be 4,000 a month, but then just a simple 4,000 every month, and then the rest is dealt with personally for all those personal expenses. Don't just kind of think, ooh, the company's got more money than I do. I'll use that to pay for whatever it might be. Okay, Tom, over to the next one. Okay, not planning for taxes. We all know we've got to pay taxes. It's bloody annoying, but we've got to pay them. So the best we can do is actually plan for it. The amount of times I've seen clients like, oh, I wasn't expecting that. Well, you pay the same bill every year. You pay the same bill every quarter. Now it's time to pull your head out the sand and actually create a plan for these taxes. We're talking about things like VAT, PAYE, corporation tax, and personal tax as well. So I don't want people to be surprised by a tax bill. You need a system that can help you estimate what those taxes are going to be as you're going along, so that you can calculate what the tax is going to be, when you've got to pay it, and therefore you can stop drip feeding money away. Just by saying my corporation tax bill is only due 9 months after the year end, just saying that, automatically in your head you go, that's a future problem. That's a future problem. I'll deal with that later. And each and every month that you say that, that bill is still building up. Just because you don't have to physically pay it, it's still building up. And if you're not putting money aside to account for that, then you will get caught out and you will find yourself in payment plans. And you'll end up paying more with penalties and interest and all those types of things. So the best thing to do is to actually look at your figures and try and create a plan for those taxes and save the money as you go, so that the money is there when the payment needs to be made. Okay, Tom, on to the next one. Okay, not paying themselves correctly. So again, I'm really talking about limited companies here. There are different ways for you to take money out of your business. So it needs to be classified as one of those ways, and you need to understand the different taxation points on the different ways that you can pay yourself. So if you take a PAYE salary, for example, that's a tax deductible business expense. Okay. And for the first 12,500, you personally won't pay any tax on that because it's covered by your personal allowance. And then you may take dividends. So the typical structure that you will probably have been advised by your accountant is small salary and the rest in dividends. And the reason we do that is because overall, it means you and your company pay as little tax as possible, which means you end up personally with more money in your bank account. But dividends in particular, they're paid after taxable profits. So let me just make sense of that. Let's say your company makes £100,000. For argument's sake, let's say there's a 25,000 corporation tax bill. £75,000 is available for you as dividends. you may have taken more than that. It's a common problem that I see, because remember that £25,000 is not payable for 9 months after the year end. So the money's there. The money's there at that point in time, so you can have it. The risk is, if you take that, you've taken more money than was actually available to you, because you're only entitled to withdraw dividends from after-tax profits. And I'm referring to corporation tax here. You've also got things like, sorry, Tom.
Oh yeah, sorry.
I'm still going to keep going. Expenses, make sure you claim for all expenses. So if your car doesn't own the business, if your business doesn't own the car, for example, but you use your personal car for business trips, make sure you ask the company to reimburse you the 45p a mile, the first 10,000 miles you're entitled to. It's 25p thereafter. That's one example. Things like phone bills. If you've got phone bills in your personal name, make sure you get them into the company, small stuff like that. Use of home as office. What else have we got? We've got things like pensions. The company can pay into your personal pension, and the company gets a tax deduction for that. So that's a great strategy to use to reduce the company's corporation tax bill, but at the same time increasing your future personal wealth, because you would hope for that pension to grow over time. And there are little quirks, something called trivial benefits. I won't go into detail here, but it's a way of getting a little bit of extra money out of the business. Life insurance, there's a certain policy that you can use called a relevant life insurance policy, where the company can pay for that life insurance. Why does that matter? Because if you imagine the company's paying for it, it gets a tax deduction. Okay, so it reduces your company's tax bill. But if you pay for it personally, you have to take the money out of after-tax profit. So there's more tax payable in the company. And then when you pull the money out, you pay personal tax. So that small insurance is diluted. So you'll find there's actually quite a big saving. Whilst the premium might be low, you could be saving up to kind of 40, 50% in tax. So little quirks like that are worth knowing, and use every trick in the book that you possibly can. Okay, Tom. Okay, here's my favorite one. What have I call this? Listen to advice from friends, family, and Uncle Bob and Dave down the pub and all that kind of stuff. Everybody knows someone that thinks they know everything, and they're quite willing to give out advice. And quite often the advice is not relevant to you, or just plain wrong. Everyone's circumstances are different, so it's always worth just checking in with your accountant. In fact, Tom, most of my calls with clients start with, Karl, I've just been talking to my mate, or I've just been talking to this chap at the gym, or been down the golf club. That's how 25% of my conversations start with clients. And I'm glad that they do, because at least they're checking in before they go and do it. And I can say, well, that might work, or that's complete rubbish and it's just not relevant for you whatsoever. But at least they're asking first. The worst bit is when you look at the accounts at the end of the year and they've done something, you pick up the phone, why have you done this? Because Dave said I could. And then you've got to unpick it, and then you're the bad guy when you've got to present someone with a surprise tax bill again, because what they've taken was not what they should have taken, for example. Okay, right, on to the next one. So I think I've already talked about this, Tom, but I just wanted to reinforce it, that your tax bill, your corporation tax bill, is not a once a year event. But also your personal tax bill. Personal tax bills actually catch a lot of people out. When you take money out of your company in the form of salary and dividends, you pay personal tax on that. So it's really worthwhile when you take that money that you park a bit of that aside in a personal tax savings account. What a lot of people tend to do is, if they take £5,000 for the month, for example, they will spend £5,000 a month, and they will take 5,000 every month and spend 5,000 every month. Then the accountant comes along and says, right, you've had income of £60,000 this year. Your tax bill is £5,000, £6,000, £7,000, whatever it might be. The client spent it. Taxpayers spent it. So what they then naturally do is go to the company and say, have you got any money? And then the company says, I've got a bit I can spare. And company pays their tax bill for them. But then straight away next year, that tax payment is a personal tax payment, nothing to do with the company. So it goes down as a personal drawing. So straight away, you're starting next year with, let's say, £6,000 of that tax bill, and that's classed as your drawings. So the next year you've got £6,000, then you put your 60 on top, then you'll find there's an even bigger tax bill the next year. And if you keep going around in that cycle, you will end up with some really, really big personal tax bills. And the things that catches people out with the personal tax bills is the payment on account as well. So if your income spikes, you will have to make the tax payment in January, but you will also have to make a payment on account towards the next tax year. And that often catches people out, particularly where there's a big spike in the income, because the tax bill goes up, but then the payment on account goes up considerably as well. And you get that double whammy effect that catches a lot of people out cash flow wise. So my advice is that when you take money out, you park a bit aside in a personal bank account, if it's when you're taking money out, and for the company, you're parking the corporation tax within the business account. So in the limited company, you save in the company's bank account. For you personally, save in your personal account. The phrase I like to use, just to get that point across for the personal drawings, is when you take your dividends, there's tax in it. There's tax in it. It's not the net pay. Okay, you've got to remember that the tax is in that dividend, and you need a system to calculate what that tax might be, so you get an estimate so you can build up over the year and not get caught out when tax payment time comes. On to the next one, please, Tom. Oh, okay. Tom's already talked about this, but it's worthwhile that I have a go as well, because this is what catches everybody out. I would say 90% of business owners I come across operate what I call bank balance accounting. And the way that that works is, as a business owner, you know what you've sold, you know what your sales are, and you always track it, and you should. And you know what's in the bank, and you always track it, and you should. But there's so much more going on that you need to see to be able to make these decisions. Bank balance accounting is looking at your bank account and going, I've got enough to pay that, so I'll pay it. And you don't really know where you're at. So profit and cash are so different, because profit will say, here's your income, which is invoices that you've issued to your customers, not when they pay it, it's when you issue it to your customers, less all the expenses, which are direct debits going through your bank account that you're paying out, and they are invoices from your suppliers. Again, you might not have paid it at that point, but you've incurred the cost and you have to pay it. So a profit and loss will show you the sum of all the income less all the expenses. Here's the profit. It would be a miracle almost if you looked at that profit and that exact figure was in your bank account. Would you say that, Tom? A miracle or a massive coincidence? Because
Never
as
seen it happen.
yeah, because as Tom said, there's so many other things that are going on. So you might have £100,000 profit, but you might have loan payments. You know, a lot of us are still paying off COVID loans and things like that, bounce back loans, civils loans. So those loan payments don't show in your profit and loss account, but they certainly come out of your bank account. Purchases of fixed assets, that money could be tied up in someone else's bank account. Who's that someone else? It's your clients, it's your customers. So again, going back to Tom's levers, you need to see that. You need to see how much is in your clients' bank accounts that should be in yours. And then you can focus on that and play with your systems to make sure that you're getting your money in quicker. You can have, sorry, Tom, sorry. Just to show it the other way, you can have cash but no profit. So I think Tom started off the presentation by saying what your business really needs is profit from your business. That's the good cash. But you can also get cash from debt and investment. And often when you're operating bank balance accounting, you can have money in the bank, but be making no money. So if you're delaying paying suppliers, delaying paying HMRC, there's money there, but it's not yours. So you've got to be really careful. And the little comment there, think heart and veins. Think of the heart as a profit, you know, pumping good profit, and then the veins taking it around your body, delivering it to the right places. You need the two of them. They work together. Okay, Tom. So to kind of round that up, your numbers tell the story of your business. A a lot of businesses are run on gut feel and emotion. And when you can actually see that in black and white in number format, it kind of reinforces that gut feel or tells you that your gut feel was completely wrong. You know, you might be earning good sales off a certain product, but it might have a really small gross profit margin, or it might even be costing you money. But you see the big sales numbers and think you're doing okay, but there's never any money in the bank because it's not profitable. So actually looking at your numbers on a regular basis helps you see the story of your business. And I've just jotted down there some different ways that you might look or use those numbers to spot trends, opportunities. How did we do last year versus how we're doing today? What are we going to do going forward? That's a good one. Everybody starts 1st of January with a plan. But if you're not comparing how that plan compares in reality to what you hoped you would achieve, how do you know when to move? How do you know which way to pivot and what levers to focus on? So actual versus forecast is a good one. And that will then give you the confidence to make the right decisions rather than always making decisions based upon gut feel. And when the cash is not there and you're working harder, you don't know why, it's because you're not looking at your numbers, which are telling the story of your business.
Okay, all right. Thanks very much for that, Karl.
Pleasure.
Hopefully everyone can see how our two sections feed from one to the other and link up to each other very closely. So any questions, I'm going to open up in just a few minutes. But what we're going to offer to everyone for joining, firstly, I'm going to offer a free financial assessment, help you understand exactly where your business is at the moment, and we about what next steps might be most appropriate for you given where you're at with your business based on that financial assessment. Karl runs a course called Mastering Company Finances, and he's offering 20% off that. He's also got a tracker or a calculator which shows you essentially how to calculate your net income after taking into account taxes. And also, Karl posts a lot on LinkedIn, as many of you will know, and he gives away 57 of his best LinkedIn posts for free. And the 16 drivers that I've just been through in my part of the presentation, I've got a PDF that breaks them all down very clearly and explains what they are and how to calculate them. So if anyone is interested in receiving all of that, then if you schedule a call with me, here's the link, synergycfosolutions.co. Then I'll make sure that you get all of that stuff. We're also going to send an email around afterwards. It won't have all the stuff, but it'll be an opportunity for you to just respond to it saying, yes, I'm interested. And then we'll make sure that you get it. So hopefully you all found that useful. I'm going to open it up to Q&A now and see what people might have.
I think there's some in the chat, Tom.
Yeah, there's a couple in the chat. So first one's from Chris, and that's one for you.
What is that? Chris, Karl, is there a limit best practice for how frequently dividends can be paid, assuming profitability? I was advised that monthly is frowned upon, but I have friends that do this. Chris, you can pay a dividend every single day if you want, mate. That there is no rhyme or reason. It's just the profit has to be there. The profit has to be there. So monthly is fine, quarterly is fine. The dividend needs to be paid. Think of a dividend as an IOU. Okay, so you have, let's say you have £10,000 available profit. You declare a dividend on, let's say, the 1st of October, and then you might draw down against that dividend for the next, whether it's month or quarter, until you run out effectively. So think of the dividend as a piece of paper like an IOU, and then the actual cash that can follow later. But ideally, the dividend should be proposed before the actual cash is drawn. But you can do that monthly, no problem at all, particularly if you know that your business is profitable and you can see that you're making X amount per month. You're making provision for the corporation tax. What's left, you can declare as a dividend and then draw that out. So hopefully that answers that, Chris. Following on, sorry, Kim, is this you asked me another question? Following on from that, how do you know what to take if they're based on after tax? Does this mean doing it? Yes, great question. Yes, it does essentially. So this is why, going back to that bookkeeping piece, You need to be able to see your numbers, because otherwise you're guessing, aren't you? You're guessing until nasty accountant comes along at the end of the year and says, did you make enough profit or did you not? To cover your dividends. So if you can get that information where you can see it, it's correct, then you can make those right decisions about how much you should be able to pay yourself. And you're also building in that estimate of tax there, Kim. That's the bit that most people miss, because that's the accountant's job at the end of the year to tell me how much tax I've got to pay.
Yeah.
It's not their responsibility, it's yours. Don't get me wrong, the accountant is the expert at calculating it, but you need to find a system where you can put provision aside so that you're not spending it before, well, it's not your money, it's the tax man's ultimately. Thanks, Karl. Already with positive DLA credit. Cool, Chris.
Anyone else got any questions? No? Okay. All right. We'll wrap it up there. So thank you everyone once again for joining. Like I said, anyone interested in getting these giveaways, just go on to Synergy CFO Solutions. That's my website. You can book a call, and I'll make sure you get them. Or you can respond to the email that we're going to send around shortly. I hope you all found that useful. If you're not already connected with both Karl and myself on LinkedIn, then please feel free to connect with us. And any questions you've got, you can message us both individually and we'll come back to you. But yeah, I'll wrap it up there. Thanks very much, everyone.